our main takeaway of this year's report is basically gold is not a contrarian investment anymore, but we're far away from, the end of this cycle. So we're somewhere like in the second half of this cycle. You're a big baseball fan, obviously. So in baseball terms, it would probably be like fifth, sixth inning.
Greetings and welcome to our Wealthion show. My name's Trey Reik of Bristol Gold Group, and we're here today with Ronnie Stoeferle of Incrementum AG, an asset manager based in all places of Sean, Liechtenstein. And Ronnie is known at the firm for overseeing portfolio management and research activities, but around the world, he is best known for his annual stewardship of a truly behemoth undertaking, Incrementum's annual publication of what really is the industry Bible annual report in the gold trade known as In Gold We Trust. If I have it correct, this is the 19th year of this endeavor, and it continues to get larger, more comprehensive, and more overwhelming on each year. The 2025 edition was just published on May 15th. And all I can say is there's simply nothing like it in scale or depth. So, Ronnie, I hope you've had a few good nights of sleep since publication, and thanks for taking the time to be with us today.
Thanks, Trey. Yeah, I had some sleep. It's getting better, but I'm kind of in the Federal Reserve would say in the tapering mode now.
Well, there are many aspects to the report that I think Wealthion viewers would find interesting. It's absolutely chock full of analysis, narratives, charts, raw data, and etc. It's also available, I believe, in 4 languages, including Japanese. But most notably, the folks that run Incrementum have chosen to make this report available to everyone free of charge. So it's almost like a massive community service effort conducted by Incrementum on an annual basis for the benefit of the gold community. So, Ronnie, how can Wealthion viewers obtain their free copy of the report we're going to discuss?
Well, just have a look at ingoldwetrust.report. You can download the report totally free of charge. You don't even have to register for our services. Just download the report. I'm kind of aware that not everybody is keen on reading 440 pages about gold. So there's also a compact version, which is still 40 pages. There's a video that summarizes this year's report. There's a slide deck which also summarizes, the best charts of this year's report. So just have a look at ingoldwetrust.report.
Perfect. And last year's title was The New Gold Playbook. This year's title is The Big Long, sort of referring to The Big Short, the movie that everybody knows about, et cetera, and how that played out over time. But from your perspective, not to put you on the spot from the very beginning, but how would you compare the two? In other words, anybody who read last year's 440-page report, why should they read this year's?
Good question, Trey. I think this new gold playbook that we described last year that basically made the case for gold being more and more of a emerging markets topic, that the center of the gold world is not in the US and in Europe anymore, but rather in China, in India, in the Arabic world. I think that has played out pretty well with, demand, not only from central banks, but also private investor demand in emerging markets being really pretty robust. But then on the other hand, what we forecasted last year was that at some point, the Western financial investor will start allocating in gold again. I think this has played out. Last year, let's not forget the largest purchases from central banks was made by European country, by Poland actually. And we've also seen that this trend of outflows from gold ETFs has reversed last year. So we're seeing more demand coming from the US, also from Europe. But I would say, like, the majority of investors that I'm talking to, when I say, well, we're still excited about gold, and now perhaps it would be time to allocate more capital in what we call performance gold, being silver, mining stocks, also to some degree commodities. Most
So
of them say, well, actually,
you brought up a topic I was going to ask you about later, but it's very intriguing. So let's cover it now. You talk about two parts of gold, one being the
safety gold,
reserve,
safe haven gold, yes.
safe haven gold, and
The other
performance
one
gold.
is performance gold. Yeah, exactly. So
So,
we made that distinction because, Trey, I think that when it comes to mining stocks, for example, my view has always been that it's a super interesting and also very challenging asset class. I lost lots of hair actually over the last couple of years. Navigating the markets of mining stocks and also junior mining stocks, and our view is that it is not a long only asset class. You really have to understand the cycle. You have to understand where we are in that cycle. So that's why we came up with this distinction between performance gold, which has to be managed on a very, very active way, and then what we call safe haven gold, which is basically the don't stare at the price chart every day. It is something really for the long game. Ideally, you inherit it to your kids or to your grandchildren. And for this safe haven gold, I think it's important that you care about counterparty risk. So you obviously want to have physical gold. You want to store it in a safe jurisdiction, perhaps outside of the banking system. But this distinction between physical safe haven gold and performance gold is really important. And I would say, like, the one of the key takeaways of this year's report is actually referring to The Big Short, this fabulous movie that I watched obviously again in preparation for this year's report. It was like, those contrarian and kind of shrewd investors like Michael Burry, that in 2005, 2006 already kind of realized, okay, something is completely wrong in this system. And now we're seeing something similar, and I would say in the monetary system. And now I can tell you, Trey, that there's like people that really couldn't care less about our monetary system, about inflation, about monetary history, that now approach me a little bit like, perhaps like 2007 or even 2008 in The Big Short, when many people kind of woke up and realized, okay, what is hitting the fan. So that reminded me very much of this current setup where, for example, like, we are openly talking about a revaluation of US gold reserves. We're now talking about auditing Fort Knox, all those things that were kind of a big topic within the gold bug community. They are now becoming mainstream. So our main takeaway of this year's report is basically gold is not a contrarian investment anymore, but we're far away from, the end of this cycle. So we're somewhere like in the second half of this cycle. You're a big baseball fan, obviously. So in baseball terms, it would probably be like fifth, sixth inning, something like that.
Mhm.
But now is the time where performance gold should be focused on. So mining stocks and especially silver.
So that's what I was going to ask you, that the components of performance gold are mining stocks and silver?
Yes. To some degree, also commodities, which is probably even more a bigger underweight by the institutional asset management community, but
Mhm.
also Bitcoin. And I know that this causes quite a lot of discussion, especially in the gold community. But our take has always been that that both gold and Bitcoin should be in a well diversified, let's say, hard asset or sound money portfolio. So we actually run two funds that combine gold with Bitcoin, and the results are staggering. So
Mhm.
performance gold for us is primarily silver and mining stocks, but also to some degree commodities as well as Bitcoin.
Got it. And we're going to throw up a chart here on one of your charts on the three secular gold bull markets. And you like to talk about the three different phases of a bull market. And I think you're saying we are in the second phase of the current bull market. Do you want to elaborate a little bit on your bull market
Yeah.
rationale?
So when I was still working in the bank, Trey, my boss approached me and said, you have to get like a certification. Um, you should do the CFA. And I said, no, I don't know. That's really demanding, and that's not, something that I really enjoy. So I proposed doing the CMT, which is the Chartered Market Technician, which is the CFA basically for technical analysis and market analysis. And I really enjoyed that education and doing that program. And one of the main, let's say, foundations of technical analysis is the so-called Dow theory. And the Dow theory says that every bull market, every big trend has three different stages. The first stage is the accumulation phase, where the sentiment is extremely negative, where everybody is bearish, where if you say I'm buying this or that at a cocktail party, people will ridicule you because it's
Mhm.
just so contrarian.
Mhm.
The second stage, which is the longest one, is the so-called public participation phase. This is the phase where basically the mainstream wakes up, banks start, covering that asset, raising their forecast, where the media picks up on that idea. And this is the longest and the broadest phase of the bull market. And then
Mhm.
the third stage is obviously the mania phase. That's the distribution phase, where those investors that did those contrarian investments early on, they start selling to what is called dump money, or those momentum chasers. And
Mhm.
my take is, Trey, that we're somewhere in the middle of this public participation phase. So gold is not a contrarian investment anymore, like you know in the year 2020, where when we published our In Gold We Trust report back then, and we said our price target for the end of this decade is 4,800 US dollars. People said, no, are they crazy? What are they drinking? What are they smoking? So
Mhm.
we're not there. We are now in a stage where, everybody is kind of feeling comfortable being bullish on gold. So when you go to a cocktail party and say, I like gold, people say, yeah, I also like gold. I bought some recently. I'm getting interested in mining stocks, let's say Newmont or Agnico or Barrick. But people don't ask you yet for the hottest silver junior
Mhm.
miner, for example. So we're
Mhm.
not there yet. That's going to happen in this final stage.
Mhm.
So from my point of view, this phase of the bull market will be more and more driven by Western investors. And a friend of mine said that actually, the Western financial investor basically completely missed out on that trend. And the majority of people say, well, now it's already too late to buy gold again. It's already too expensive. So we're kind of climbing this wall of worry. And that makes me pretty confident that, we're not at the end of this trend. And if you have a look at this chart where we compare the current bull market to previous bull markets, you can see that in the 1970s, for example, we had 209 all-time highs. In the 2000s, we had 106 all-time highs, and now so far we had 76 all-time highs. So clearly, we're now in the trending phase where there's also more CTAs coming in, more let's say momentum chasers. And I think that this current consolidation is a very, very important and a very healthy one. But from my point of view, we're not in this mania stage. That's going to happen sooner or later. And I would clearly see that we should hit our long-term price target at least, which is $4,800 over the course of this third and final stage of the bull market.
So I had planned to sort of hit technicals last, but since you brought them up, you in the report cover several very compelling technical, because I really think technical is a secondary thing, but since we're talking about it, you mentioned the optics model and the Midas touch gold model and the gold, Dow to gold ratio. Could you just give us a brief synopsis on where those three stand?
Yeah, well, the optics, which is done by Sentiment Trader, I think that's very, very interesting. That we are already seeing kind of extremely bearish sentiment when it comes to mining stocks and also to silver, and pretty much of a neutral setup when it comes to gold itself, which is telling me, okay, we've seen a consolidation.
Were they higher before? Were they higher and they come down, or they just haven't gotten really high?
No, they were obviously higher. So they were like in euphoria mode. But the fact that it's cooling off so quickly is a very encouraging sign. So that kind of confirms my view that the market has lost confidence in gold pretty quickly, which is something that you normally don't see at the end of every of a trend. The Midas touch model by my friend Florian Grummes, it went to a somewhat bearish signal quite recently, which also confirms my view that we shouldn't expect too much from gold over the next couple of weeks. So usually the seasonals are not very favorable for gold. I can tell you, Trey, that every year we published a report around mid-May, and the date when we basically hit the send button, it's always, gold is always trending down. It's always in the reds. It's always correcting. So and people say, well, you just published 400 pages about gold, and gold is selling off. You must be like the the poorest market timer ever. But this is always, usually we're making a bottom around July, August. So don't expect too much from gold at these levels. And let's not forget, we're up 23, 24% year to date. That's a massive move. That's a massive move within a very short time frame. So we have to digest that move, like, running up a hill. Sometimes, you have to slow down. You have to catch your breath again. And that's what we are doing at the moment, I think.
So you brought up the year-to-date performance. And by the way, that feeling that you were mentioned, that whenever you publish the report, you may be confusing postpartum depression with, no, I'm just kidding. Once you do a big report like this, it's always tough to exhale. But anyway, looking at gold's performance last year, the S&P, at the beginning of last year, nobody thought stocks were going to go up. We were going to have a recession 2024. The Bloomberg strategist poll in December of 23 was the most bearish it had been in 25 years. And then, of course, we had 25.2% performance or something like that for the S&P. And, of course, by the end of the year, the same strategists were more bullish about 25 than they had been since COVID. So that's just the way the world works in equity land. But throughout that whole thing, gold was up 27%, outperforming stocks last year. And this year, that infamous 1 minute on April 22nd, where gold traded at 3,507 cents, which I have on my wall in the office, lasted, about 15 minutes. But at that moment, we were up 33% for the year, which is, I don't think anyone in the gold trade community or on Wall Street would have expected that in, 5 weeks. So the question becomes, there are all these, for decades, you and I have followed fundamental trends like eroding Fed credibility, anti-dollar sentiment, de-dollarization, the U.S. debt levels and deficit. But obviously, some of them are hitting these seminal inflection points where they really matter. So if you were going to sort of stack them up, what would you rank as your fundamental reasons why gold has done so spectacularly well so far this year and is likely to continue?
Well, I think first of all, it's a loss of trust
Mhm.
in the U.S. leadership. That's obviously something that I'm experiencing firsthand over here in Europe, and I think it's pretty similar in Asia as well.
Mhm.
So that's one thing, and I think the best confirmation of that is if you remember Liberation Day. Well, there was quite some panic in equity markets, and what you usually would expect is the U.S. dollar, trading stronger, trading up, and also this uh, more flows into U.S. Treasuries, but we saw exactly the opposite. So the U.S. dollar was actually down. Yields went up. So I think that was another sign for this paradigm shift that we're seeing. There's lots of capital leaving the United States now, going into Europe. The German DAX index, for example, is one of the best performing equity markets globally. Um, and I think that, for the US dollar, now we're seeing, I think Bank of America had that recently, being bearish on the US dollar is quite a consensus trade. So I would expect the US dollar to bounce back a bit, but a weak US dollar is actually that's kind of or one of the foundations of my thesis for gold going forward. Now, I think, Trey, that one of the things that really astonishes me is the fact that over the last couple of weeks, I think like mid-February, the market was discounting 4 to 5 rate cuts by the Federal Reserve. Now we are at one. Usually, we would have expected gold to face like big headwinds in such a scenario, but
Mhm.
actually, gold was not really affected by that, and therefore I think that this bull market is really standing on a very, very strong foundation, which is, as I've mentioned, this loss of trust in the US leadership. Then on the second hand, I don't think that actually equities are kind of the enemy of gold. It's rather bonds, and obviously bonds are like a far bigger asset class than equities. And if you have a look at the yields in Japan, but also over here in Europe, if you have a look at U.S. Treasury yields, you can see that this foundation of every institutional portfolio is now really being questioned. Um, and I think that's really a strong case for gold being kind of the anti-bond. Then we're seeing still very, very strong demand from China. We all know that the People's Bank of China owns significantly more gold than they officially announced, but it's also private demand that is still, it seems it's very price insensitive. And then I would say one very important trigger going forward, and we have a big chapter on that, and we also feature a conversation that I had with Luke Roman and Louis Vicente Gav, is of course this whole topic about Mar-a-Lago Accord. How will the U.S. kind of redesign our monetary system to deal with the Triffin dilemma? Is some sort of a big currency reform? Is it going to happen? And I mean, Scott Bessent, he said, he knows that something like this is going to happen. He said he wants to be part of that solution or of that development. And
We
he
could
also
throw up a
said that,
chart here, which is your firm's view of structural dollar decline being part of the Trump agenda, so folks at home can see your point. But continue.
yeah. So and Scott Bessent said, people called him a gold bug, and he was he was working for Soros. He's good friends with Stan Druckenmiller, probably the greatest trader of the last couple of decades. So I think he clearly understands what's going on and what has to be done, and therefore I would say that a weaker dollar, structural decline is something that we will see over the next couple of quarters probably. So I would be on a relative basis. I would be even though based on the fundamentals it sounds crazy, but I think the yen has room to go. Many Asian currencies and even the euro probably will do pretty well versus the US dollar, because the world wants and the world needs a weaker US dollar. Now, the big question is if such a, let's say, a controlled devaluation, if that's really gonna work. So we write in the report, it's like asking for warm ice lollies, or trying to square the economic circle. That's obviously something risky. But if you have a look at the dollar chart, uh, we haven't seen anything yet. So if we go back to levels where, for example, 2011, where we also saw the peak of the last big gold bull market at 1900. The US dollar index was trading at 75, so that would still be roughly 25%, 25 percentage points down. So I think that's going to happen. I think that's also one of the reasons why Donald Trump is now, trying to make concessions and trying to, warm up the world for this development. And again, a Mar-a-Lago Accord, it's not a question of if, but rather of when it's going to happen. And of course, we can talk about the details at length. We talk about, for example, gold-backed bonds. Judy Shelton has come up with that idea. There is this very important paper by Stephen Miran. There's great papers by Michael McNair about that topic. It's a very complex topic, but I think this will really become kind of center stage over the next couple of months.
You mentioned the Triffin dilemma, which briefly for viewers is the dilemma that no individual country can forever issue the reserve currency for the whole world, because it will lead to artificial external demand and a structural current account deficit, which is unsustainable. That's what you're referring to?
Yeah. So
Right.
Triffin said basically that the world needs a steady supply of the reserve currency for trade, for investment, and also for reserves. But then on the other hand, you also need that national stability. So the US issuing the reserve currency must maintain fiscal discipline and monetary discipline to kind of preserve confidence in its currency. So this is kind of the dilemma that we're in. And there's a couple of solutions for that. Keynes talked about the banker at Bretton Woods, actually. And my take is that we would need a neutral reserve currency that is obviously that is as I said neutral, but it also has to be highly liquid. It has to be traded 24/7 with a tight spread. It has to be accepted all over the globe. And, I don't think that the Chinese yuan really fits that criteria. I'm not sure about Bitcoin, but I think that gold would work pretty well. So
So you
perhaps we're seeing some sort of a silent
Mhm.
remonetization of gold currently. And the fact, Trey, that the US has imported 2,000 tons of gold over the last couple of months,
Right.
that kind of confirms that view.
So what I was going to ask, this is a perfect play. Do you believe, and I don't think there's many of us, but I think I believe, and do you believe that gold will, other than foreign exchange reserves, play a role in the evolving monetary system?
I think it always has played a major role, but
Okay.
it wasn't something that central bankers were very keen talking about.
Hmm.
I think Bernanke said its goal is just a tradition.
Hmm.
I once talked to a very renowned central banker, and I will never forget that conversation. And he said, "Mr. Stoeferle, there's one thing that central bankers don't like," and he made a big pause. Transparency, Mr. Stoeferle.
Yeah.
So I think the fact that gold is still by far the most important reserve of basically every central bank globally. The IMF holds more than 3,000 tons of gold. Um, all those emerging market countries that are doing so well from an economic point of view, that have, high real rates where capital is flowing into those countries, they're increasing their gold holdings.
Mhm.
On the other hand, we're seeing that, for example, the euro system. So the central banks in the European or in the eurozone, they're actually they're valuing their gold mark to market, and not like the US at 42, which gave them actually all those losses that they had to live with over the last couple of years. They were pretty well compensated by the surge of gold recently. So
Mhm.
it actually for the Swiss National Bank, for example, which is kind of being run like a Fed hedge fund these days. Actually, their gold holdings of, I think, more than 1,000 tons actually made up for most of the losses that they've made. So I think this silent remonetization is happening. I think it's getting a little louder,
Mhm.
and that's not a that's really a global trend. And if you connect the dots globally, I think that gold will play a major role going forward. And I think if that's going to happen, I think people will say, well, I should have bought more gold when it was trading at 3,200. It was just dirt cheap.
Right. You mentioned the Swiss and the money that they've made on their gold holdings. It's incredible to remember that they sold 1,200 tons in that late 90s period. I mean, England gets all the attention for that 300-ton sale right at the end, but the
Yes.
Swiss were sellers for a decade. And remember, that was just, looking back, what an incredibly bad decision that was.
Absolutely. I mean, on a per capita basis, the Swiss still has, I think, the largest amount of gold. Um, but the opportunity costs of selling that gold, they were enormous. And we had it also in my home country, Austria, where
Mm.
just to basically come up with a balanced budget in 1 year, they've been selling more than 200 tons of gold. And the opportunity costs are enormous. And Trey, one thing that I forgot before is, talking about the new monetary system, it's not only the gold purchases by central banks, it's also the repatriation trend of gold.
Mm-hmm.
That is, I think, very, very important. It basically started in 2011. And since then, more than 2,000, I think 300 tons of gold were being repatriated. So basically brought back home from London, from New York, to Poland, to Austria, to Germany. And that's really a big international trend. And also, seeking physical audits, full sovereign custody. Now in the US, it was a big topic a couple of weeks ago. Now it kind of, Trump forgot about that, or perhaps not. But, auditing Fort Knox, that was like a really big topic quite recently. So I think those are all signs that gold is really coming back, let's say, center stage of the next monetary system.
And to show how a partial cover clause could work, if you work through the math with me, if we took the Fed's $6.7 trillion balance sheet and we assumed a 25% cover clause for all central banks, that would mean that the Treasury's 261 million ounces of gold that's held on the Fed's balance sheet would have to be valued at about 6,400 an ounce. So my point in bringing up this math is, even for very, very, very large balance sheets like the Fed with gold in the 3,000s, a move to 6,000 wouldn't necessarily cause a revolution or social unrest or something. We're in that realm where it's pretty thinkable.
Exactly, and we are again discussing this so-called shadow gold price that we talked about previously in other In Gold We Trust reports, and obviously from I would say on a monetary, if you have a monetary view on gold like we have, you always have to consider the fact that M2 is growing roughly by 7%, I think, since the year 1900. Actually, that M2 growth was fairly muted over the last couple of years, and that kind of confirms my view that gold is already kind of smelling that something's gonna happen. Like my friend Larry Lepard, he wrote the book called The Big Print. So the big print could be one of the reasons for the big long in gold. But again, from a monetary point of view, I think gold is very, very cheap. So we come up with historic gold coverage ratios of 25% or 40%. And then also various different monetary aggregates like central bank narrow money supply, but also
We have
M2, M3.
we have your chart on historic money base,
Exactly.
monetary base. We'll throw that.
So that's and then we arrive, if we just reach like long-term averages. We're talking about significantly higher prices, and also, usually big trends, they don't end at the long-term averages, but at the extremes. So we can easily come up with prices between 8 to 10,000 US dollars based on those historical comparisons. If there's like some sort of a monetary of a gold backing of our monetary aggregates again, and usually, that goes hand in hand with, let's say, falling confidence, falling trust in the system, and obviously, I mean, it's no coincidence that our report is In Gold We Trust, and back then, 19 years ago, when I came up with the first In Gold We Trust report, to be honest, I didn't understand the importance of trust, not only when it comes to money, but when it comes to business, when it comes to our society, when it comes to the media, when it comes to science. Trust is really something that glues us together, and this erosion of trust that we've seen over the last couple of years is something that is actually pretty worrisome. And I think the less trust people have in in our system, the more trust they will put on gold, because it's something that has delivered, has held its how do you say, its expectations, or its characteristics over the last not only centuries but also over the last 5,000 years or whatever. So that's basically, it's the inverse of the trust in our monetary system.
So, on a micro level, that we in June had the Basel III Accord taking effect, and I have read treatments of the fact that part of the reason for gold's recent strength could be that gold is being reclassified from a tier 3 to a tier 1 asset, and its reserve requirements will go way down, and it will also make gold far more attractive in a physical form than a derivative form. And that may be why we've had a lot of the flushing out of COMEX and paper gold type positions. As you move around out there, have you come into contact with that, or do you think that's overthinking a bit?
To be honest, Trey, I think that many people mix up this HQLA with tier 1 and tier 3 capital. I talk to many bankers, and Basel, at Basel 3, physical gold is tier 1, while paper gold is tier 3, basically. So the system is kind of, the system itself is rewarding metal over let's say metadata. But then on the other hand, talking to bankers, I have to say they couldn't care less about gold. So if you're like talking to a treasurer in a big bank, if you're talking to people on the trading desks, gold for them is still something, that has risen, obviously, but they don't care about it. Yeah. So I think that let's say we in the gold world, we think that everybody is waking up in the morning and just staring at the gold chart, and that's that's like the most important thing. But then somebody told me that there's actually more people in the United States that believe that Elvis is still alive than people that actually own any physical gold. And I think that's a pretty good way to describe that. So, I think that we make a little bit too much out of this Basel III, that I don't really see playing out in the real world. But if it's going to happen, so be it. Yeah, I'd be happy about it.
Terrific. So I've got a couple of sort of random questions, as we've used up a lot of your time. But one of them is in the report, you talk about different methods to start to approach the concept of calculating, an appropriate intrinsic value for gold. Mm-hmm. Can you just give us a brief, brushstroke on which methods you have found the most compelling?
Well, I'm not only from Austria, but I also adhere to the Austrian School of Economics. So value is something highly subjective. There is no intrinsic value from my point of view. What's the value of a Van Gogh or a Picasso painting? It's actually what people are willing to pay. What's the price of, let's say this declining marginal utility after a long hike? The first beer is excellent, but the marginal value of the fifth beer is obviously far lower. So I always have a somewhat hard time saying, just based on our model, this is the fair value of gold. It's just, and this, that's a fascination that I still have for the topic of gold, that actually, if you really want to understand, or if you try to understand gold, you have to understand everything. You have to understand geopolitics. You have to understand inflation, opportunity costs, equity markets, where interest rates going. So it's a highly, highly complex thing. Mm-hmm. Based on our incrementum gold price model, which is a very simplistic model. It basically has some sort of a trust factor. So how high is trust in, let's say, the monetary backing of the US dollar, and how high is the growth of M2? Based on that, our base case is still 4,800 US dollars by the end of this decade. Again, we said that in 2020, people thought we were crazy. We stick to that price target. If there's a second wave of inflation happening, and I cannot rule that out actually, then our model says we can go up to 8,900 US dollars by the end of this decade. So that basically says, well, gold isn't dirt cheap anymore. But still, there's, I would say there's some asymmetry, because I don't see too much selling pressure for the time being, and therefore I would say, like we talked about at the beginning, now in this next stage of the bull market, now it's really time to consider those performance gold assets, because let's face it, silver has been a disappointment. We're now seeing the fifth year in a row where actually demand is higher than supply. We haven't seen any investment demand really kicking in. Mining stocks, Trey, I mean, you know everything about that. They were a big disappointment last year. This year they've done better, but they haven't shown this let's say 3-to-1 leverage on gold so far. So I would say that the more appealing for us as asset managers, the more appealing risk reward ratios are actually in those performance gold asset classes that haven't done so well. But it's always like gold going first, and then with a slight delay, there's silver, mining stocks, commodities following gold, and then they're starting to outperform gold. And so that would be my take going forward. And let's face it, if you're at the cocktail party back again and you say, I like gold, but I even more like silver, and I even more like mining stocks, people will say, oh, mining stocks, come on, they've been such a big disappointment. So that's definitely more contrarian than gold at the moment still.
And just rounding out this thought for where we are in the cycle, I really enjoyed your chart, sort of a pie chart we'll put up on the asset dispersal at family offices, where things are invested, and the percentage that gold represents. Can you just talk a little bit about how small the gold allocations are?
Yeah. So Trey, that's one of my favorite visuals of this year's report. That's based on UBS data, and that's for international family offices, where at the end of 2023 they had gold allocation, gold and precious metals, of just 1%, which is the same league like infrastructure and art. So is there some potential coming from the institutional side? Definitely. And I can tell you that in one of our funds, there was one small Swiss pension fund actually starting to allocate capital. So it's slowly starting. And therefore, if we come back to the Big Short, I think it's probably like 2007, where also like usually, let's say that the bigger an institution, the more bureaucratic and the longer it takes for them, to make any decision. And we're seeing now for some smaller institutional players, some smaller family offices, but also pension funds, they're now, they're asking us, yeah, this gold thing and also mining stocks, that's something that we're kind of considering. And I think this is really the potential for gold going forward. Those market participants that are heavily underweight gold, not allocated in mining stocks at all, even though they've got the best balance sheets that I've ever seen. They're free cash flow monsters. They've been paying down their debt. They're increasing their dividends. They're buying back their stock. They're really in a very, very healthy shape. But nobody's allocated yet. So I think that's really the future demand will come from those institutional players that aren't allocated at all.
Terrific. And for our US viewers, there are some fairly significant hurdles to getting involved in your products directly. While the In Gold We Trust report is out there for everyone to appreciate. For the rest of the world, from Canadian through Europe and around the world, what's the best way for individual investors to get in touch with Incrementum?
Well, yeah, Trey. It's interesting that everyone on this planet, yeah, from New Zealand to Greenland, although we don't know what's going to happen to Greenland, so that's perhaps not the best example. But everybody on this planet can buy our funds, but U.S. citizens and U.S. Residents. But for everybody else, just have a look at our webpage, incrementum.li. We're an asset manager based in Liechtenstein, from my point of view, one of the best jurisdictions within Europe. Not a member of the European Union. We've got the Swiss franc as our currency. It's a very small country, one out of 5 countries on this planet without any debt, without any government debt. So just have a look at our webpage, incrementum.li. We're heavily focused, I would say, in the real asset space, so commodities, gold, but also Bitcoin. That's in our DNA. Value investing. We do not only offer investment funds, but also private wealth management services. So just have a look at our webpage, incrementum.li, or if you're from the United States, then perhaps in Gold We Trust report, because the next time I enter the US, I want to be safe and not be delivered to Guantanamo right away. So better play it safe.
Excellent. Well, thank you very much for your generous commitment of time, and even more for your dedication to the In Gold We Trust franchise, which we really appreciate out here in the gold community. So thanks very much, Ronnie. We look forward to checking up with you in a few months or so.
Thank you very much, Trey. It's been a pleasure. And yeah, same to you. Thanks for everything that you do for the community. I really appreciate it. And I'm a subscriber of your services as well. So thank you very much.
Thank you.